Welcome back to Stuff About Money. I'm Xavier Angel, certified financial planner. And as you guys can see today, I'm running the show by myself. I had to give Eric the boot today because oftentimes when I'm out, he will run this show by himself and do these interviews. So um, I am joined today by a friend of mine and a CPA, Keith Raymond. How you doing this morning, Keith?
I'm good. How you doing?
I'm doing good. It's a rainy morning outside, but other than
Yeah.
that, I'm enjoying it. So, but you can't see by your background. Is it still raining out that way?
No, it's pretty clear now. It had stopped raining by the time I got to the office a little bit before 9 o'clock, and
Okay.
it stayed pretty clear. So but
Okay.
yeah, definitely raining on the way to work today this
Yeah.
morning.
We're gonna, Keith, give us a little bit of a background about you. As I mentioned before, you're a CPA. I think you've been practicing since what, 2005?
Yeah. So I was I was born and raised in New Orleans. Went off to LSU, and I had graduated, had my undergrad in 2004, and graduated with my master's in accounting in 2005, which, as we all know, was the Katrina year. So I actually started practicing in January of 2005, started getting my feet wet, and then Katrina hit, kind of chaos. Got Went to Houston for several months, came back, was working a little bit from the office, some from home. So it was a chaotic beginning to my career with Katrina and being dispersed, and then coming back and trying to and from a the I'm in the tax practice, and from a tax standpoint, it was pretty crazy because we were, typically you're a year behind anyway with tax.
Mm,
We're right now in March of 2024, we're doing 2023 tax returns. Well, because of Katrina, we were doing 2004 tax returns in 2007. So it definitely wasn't a typical start to my career. Um, but it was a good learning experience. It was kind of a trial by fire. We went in, so I learned a lot. It was a good experience. I was with Ernst and Young for almost 9 years before I left. While I was at Ernst and Young, I worked on a variety of industries: insurance, oil and gas, the hospitality industry. So it was a good. New Orleans is kind of um, a unique city in that it's got a lot of different industries, and but not too many huge companies. So as a result, the New Orleans office got to work on a ton of different clients. I mean, I had a bunch of different clients, many different industries. So learned a lot. And when I left there, I joined an oil and gas company on the North Shore, where I continue to work. Um, it was my client for the entirety that I was at Ernst and Young. Jumped over here, and so came over here in 2013. Worked here for a good bit, and in 2018, um, constantly had family and friends asking, "Hey man, can you do my tax return? Can you help me out with this?" And I was in part helping people doing some tax returns for family and close friends. But I had so many people ask me. I said, "Man, I think it's time to start it for real and do it on my own." So started my LLC, which I know we'll talk about, and converted it. And since 2018, I've been working on, I started my own side practice. I'm still working on the North Shore with the oil and gas company, but since 2018, I've had a variety of individuals and small businesses that I've worked on and helped out. And one good thing I remember back at Ernst and Young, one of the partners telling me one good thing about the tax side of public accounting is you're working side by side with your client in helping them, achieve the best possible outcome of getting their tax liability down as much as possible, and structuring things that works best for them. So it's been a good experience, and 20 years later, here I am.
and going on 6 years on your own practice. So
That's right. Yeah.
congratulations on that. So one of the things that you did not mention, and I've got to throw
Mhm.
this out there, two state champions, two state championships, or was it three?
Three
Three state
is actually
championships in football.
three state championships at football. Now, look, I'm not going to claim to be that I was a star player or anything. I played some. I was on the team, but yes, we did. John Curtis graduated in '99, and yes, I was fortunate enough to be on a team where we won 3 state championships. My last 3 years playing there. Yeah, it
And
was.
and now and 3 daughters that dance. So you're a dance dad right now, then.
I am a dance dad. I desperately, desperately wanted them to do some type of sports because I played sports growing up, and I really, really wanted them to do that, but it wasn't in the cards. They're all dance girls, and it is what it is. So now yes, I'm a dance dad, and I've embraced it. And, you know,
Yeah, I
uh,
got that question yesterday. I was dropping Grace off. So Grace found out 2 days ago that she made one
I,
of the local dance teams. And
yeah.
so the coach looks at me and she says, so you're a dance dad now. And that never thought I would be there because, as you said, I thought Grace was going to follow in my
Yeah.
footsteps and play sports. And
Hmm.
she's fallen in love with dance. Although um, over the past over the past 6 months, I've realized dance is just as much as a sport than
Oh yeah.
anything else, based off of
And
all
it
these
takes a ton
things
of
that they do.
athleticism too. Yeah,
Right.
for sure.
So
For sure.
today's conversation is revolving around and based off of a lot of questions that Eric and I get from 3 of our client base that we work with. So agency owners, right? These are guys that own their own insurance agencies, and they've asked us questions regarding LLCs and S corps, as well as working with our pharmacist. I married into that pharmacy industry, so it was a natural fit for me to begin working with both pharmacists and pharmacy owners. And then that third one is attorneys. A lot of these attorneys now that we work with, they're starting their own businesses, they're splitting away from their firms and going out on their own. So the questions that we're going to talk about in the topic today is really revolved around those three industries. So in getting started with it, one of the big questions is what's the difference between an LLC and an S corp?
Okay, so first we'll go ahead and make the distinction that an LLC, an S corp. I'm gonna kind of back up. S corp is a tax distinction. Okay, so park that, put it on the side. I'm going to come back to it. An LLC is a legal term. So a lot of the lawyers are going to be familiar with that, but not everybody else is really familiar with that. An LLC, some people may or may not know, it stands for limited liability company. It's a separate legal entity from an individual that may start a business. Now, an LLC is you can distinguish it from a corporation, right? Like a corporation, when most people think of corporation, they think of bigger companies,
Mhm.
larger. Corporation's a little bit more complex. You got to have articles of incorporation. There's certain bylaws. It's a little bit more complex from the formation standpoint. An LLC is a little more simple. It can be started, most states, certainly in Louisiana, someone can go to the Secretary of State website and do it themselves. It can get a little complicated, so you may want help from a CPA or a lawyer. But an LLC is strictly a legal term where it's a limited liability company that is separate and apart from an individual person. So a lot of times people will start an LLC as their business. However, the LLC is not a tax distinction. So, and I'm going to say that again because most people don't understand that. I've had
Right.
bankers call me and say, "Hey, man, is this taxed as an LLC or an S corp?" And I said, "Well, it's an LLC, but it's not an S corp. It's an LLC, but it's taxed as an S corp." And and the bankers are like, "Wait, that doesn't make
Right.
sense." So, look, just
And I was
to
going to
again,
ask you about that as well. So,
yeah. So that's that's why I'm kind of I'm spending a little more time on this. And the way the process goes is an LLC is created. Once that LLC is created, at that point in time, then we have to say, okay, that's a legal distinction. Now let's look at the federal tax distinction, right? And I'm going to focus on the federal part of it because each state's a little bit different, and really, the
right.
federal part of it is the primary tax liability, right? So once you create an LLC, then at that point, the taxpayer, the person that created the LLC, has to make a decision as, okay, well, how do we want that LLC to be taxed? There's three primary ways that it can be taxed. If it's a single owned entity, you've got one owner, whether it's your pharmacist, the lawyer, maybe it's the one person that owns the insurance agency. If it's a single person that owns that LLC, there's two things you can do. You can either be a sole proprietor, where you do nothing. That's the default classification, where what's going to happen is the activity of that LLC is going to get taxed on the individual's tax return. It goes on Schedule C of the tax return, but basically it's on the individual tax return, the 1040 form. It's a separate schedule, and all of the business activity is going to get listed on that form 1040, and it's going to flow through with the rest of the individual's tax return.
So I'm gonna unpack that a little bit.
Okay.
So
Yeah.
that business income then flows to the individual, the member.
Well, so I'm gonna stop you there. The word flows, I wouldn't say that, because that's we're gonna use that with an S-Corp.
Okay.
Um, I would say it is it's gets reported on the individual's tax return. So it
Okay.
ultimately is going to end up on the individual, but on a sole proprietorship, it's going to go directly onto the individual's tax return.
Okay. And then that sole proprietorship, that's if I come in and I open up a business on my own, then that's
Yeah,
considered sole proprietorship, correct?
you create the LLC. It's one owner, right? Just you yourself. You create the LLC. Um, if you don't do anything else, the default is it's going to be considered a sole proprietorship for federal tax purposes, and it's going to be reported directly on your individual tax return, your Form 1040.
Okay. Got it.
So that's option one if there's a single owner. Option two is going to be to elect uh, the subchapter S status, which would get you to the S corporation. There's a couple of different forms that you have to file with the IRS. They're not difficult, but I would recommend that you get a CPA or a lawyer's help with that, just to make sure you do it right, because you want to make sure the proper forms are filed timely, so you can do the S corporation status. And what happens with that is, if you elect that and the LLC is taxed as an S corporation, then the business is going to file its own separate tax return. The business activity is going to be reported on, it's a Form 1120S. That's the S corporation tax return. The business activity is going to be reported on that form. And from that form, it's called a Schedule K1. That's the activity that is going to go to the owner. And then that is going to flow to the individual's tax return on Form 1040.
Okay.
So it's a little bit different ways around it, and I'll get into the advantages and disadvantages of the sole proprietorship versus the S corp. But ultimately, like I said, the distinction is LLC is not a tax designation. LLC is a legal designation, and once you create that LLC, then you have to decide, is it going to be taxed as a sole proprietorship or an S corporation?
Okay.
Before we get there, because there's a couple of distinctions, if there's more than one owner, right? If you have two or more owners, the S corporation election is pretty much the same. Even though you have more than one owner, you can elect the S corporation status. It's going to file its own tax return, and it'll flow to the owners.
Okay.
The opposite side of that. So since there's more than one owner, the sole proprietorship option is no longer an option, because that's for a single owner. So if you don't do the S corporation status and it is more than one individual, then default is a partnership for federal tax purposes. A partnership also files its own separate tax return, and the activity of the business gets reported on a Form 1065. That's the partnership tax return. And similar to the S corporation, the partnership tax form will provide K1s to the owners for the business activity, and that will get reported onto the individual's tax returns, Form 1040. A little complicated, but it's
a lot, and that's why I'm glad you're on here, because not only do our listeners want to learn about that, but look, this is teaching me. I know enough to be dangerous. So I'm definitely glad you're on here. So the LLC is just that legal document. And then
Hmm.
once I create that LLC, now I have to choose um, how am I going to file for federal tax
That's
from a
right.
federal tax standpoint.
That's
Um,
right.
okay. All right. Gotcha. Now,
Yeah, look,
one
the
of
LLC, if just just to be clear, the LLC again, it's a legal designation, and it's important because it gives the owner some protection from, the whole purpose of the LLC, the limited liability company, is to protect the assets that are in the business to the business. Because if something happens with the business and you either get sued or goodness, you had to file bankruptcy, the assets are in that entity in the LLC, and they're protected from the owner.
okay.
If you don't create the LLC, if I go out and um, I start a business and I don't create an LLC, problem is if I get sued or if I go bankrupt, then they can go after my personal assets.
Okay.
And so that is the important part. LLCs are very, very important, and they're almost always recommended to create an LLC when you have a business. But it's for that reason. It's that legal protection. It's that um, it's 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 that part that you want to do the LLC for, and then the tax designation comes after.
So if I go out and we've got so in part of our planning, people come to us and ask, well, what about my real estate, right? What should I do with
Hmm.
my real estate? So if I come out and put my real estate, or I purchase a home, or the LLC purchases a house, and let's say
Hmm.
$300,000, it's inside that LLC,
Hmm.
and I file bankruptcy, or I'm sued for whatever the reason is, then my liability, if I'm correct, if I hear you, if I'm understanding you correctly, my liability now is only $300,000. Is that accurate?
It is. It's the assets that are inside that LLC are protected. Now, there's plenty of rules that are probably beyond the scope of this conversation that we get into, that
Hmm.
that you do have to be careful not to. You have to treat that LLC separately like a business, meaning that you really don't want to have anything personal assets in that LLC, and you don't want to
Hmm.
take personal funds in and out of there, because that could compromise
Okay.
the the protection that you have with the LLC. But basically, for the most part, what you're saying, that's correct. And
Okay.
and look, that could a lot of people that buy rental properties, if you can, it's good to have those in LLCs for that very reason. When you're in an LLC, you have insurance, homeowners and liability
Hmm.
for reasons. But if anything happens, someone falls and hurts himself in the home, you want to make sure you're protected and have that within those LLCs. Otherwise, it could cross over into your personal assets and your personal
Okay. Okay.
effects.
And at what point, so if I'm running my business out of an LLC, at what point does it make sense to come in and change my tax filing status to an S corp?
So an S corp, there are some restrictions to S corps, although most people and probably most of the clients that you all deal with are going to be fine. S corps, you can't have more than 100 members. It's got to be domestic. So there's a couple of things, but for the most part, I would say 99% of your clients and my clients can get into an S corp. The benefits of an S corporation, for the most part, come down to a popular strategy that's used is earnings within an S corporation are generally not subject to self-employment taxes. Um, and so, what happens is a typical strategy is someone creates an LLC, elects an S corporation status. Um, as long as the person can pay themselves a salary that's reasonable. Um, what happens is any earnings above and beyond your reasonable salary won't be subject to self-employment taxes. And that can be a significant
Mhm.
number, because self-employment taxes, if you own your own business, you're going to be subject to self-employment taxes, uh, and that can be a little above 15%. So, that's the most advantageous part of creating an S corporation. Um, and it's something to think about because it's a very facts and circumstances scenario where you want to get with the client, sit down, look at their books, look at their projected earnings, and see whether or not it makes sense to create that S corp. Because with the S
Mhm.
corp comes some more administrative filings, right? It's got its own
Right.
tax return filing. You got to if you're going to pay yourself, you have to set up a payroll with W-2. So it does have some additional costs, but
Okay.
that's when it becomes most beneficial to elect the S corporation status.
Now you mentioned on that with the S corp, 100 members or less. By members,
Mhm.
I'm assuming are you talking employees,
Owners.
owners?
No,
Okay.
no, I'm talking about owners. So
Okay.
a quick little thing is LLCs. Um, it's typically the owners are referred as members. Limited liability companies have members, which are owners.
Mhm.
That's what I mean by that. So you couldn't have more than 100 owners, which is why I said it's not going to affect 99% of our clients.
Gotcha. And from also with the S corp, from the standpoint of if I have employees, are there any
Mhm.
benefits to being an S corp when we start talking about employee benefits and offering things to our employees? Is there a benefit for going to the S corp over the LLC in that case?
Um, so the LLC again, you're gonna if you don't do the S corp status, if you're single, it's going to be the sole proprietorship. If not, it's
Hmm.
going to be a partnership. There are a couple of small differences if you have an employee with an S corp, employees under an S corp. Um, but as a partnership or even a sole proprietorship, you can still have employees and you can still offer benefits to where there's not a huge difference between an S corp and
Hmm.
and the default classification, either sole proprietorship or partnership. It's more comes back to the earnings above and beyond what you might pay yourself as an owner
Okay.
as W-2. There's not too much of a difference in the employee benefits.
Okay. So when considering how to file my federal taxes when I'm creating my business, then obviously the first is we're going to recommend that all of our listeners go out there and talk to your tax professional, your CPA, your attorney, get with them and figure out what's the best route to go. But what are
Mm-hmm.
some other things that our listeners should think about that really stand out to you that they need to think about when deciding what route to go?
What route to go on the tax side?
Correct on the tax side.
So the primary difference, if you've got if you're by yourself, I would say that coming back to the administrative part,
Hmm.
it's a lot more simple. If your business is fairly simple, and you're not going to be earning enough to justify the savings that you could potentially have with the S corp, then it may make sense to just go with sole proprietorship. It's certainly much easier just to file on the individual's tax return. Um, it's administratively it's easier. It's all confined into one return. Um,
Okay.
when you have more than one owner, there's a little bit of a more distinction. So we talked about it earlier. When there's more than one owner, the two options are either a partnership
Hmm.
or an S corporation. A partnership, um, you get a little bit more flexibility in how you can handle basically how you can allocate activity among partners. And what I
Okay.
mean by that is, um, I don't want to get too detailed because it's
Right.
probably a little more complex than we need to be. But for example, within a partnership, you and I can get into a business and start a business, and we each should go in and we say, all right, we're going to start this business. We're each going to put up $10,000. You start having activity. Well, then it's like, oh, we need some more capital. Um, how are we going to do this? And we're 50-50 owners,
Hmm.
but we need some more capital. I go to you and I say, Xavier, like I don't have the cash right now. Can you put up an extra 10,000 and we can use that? Uh, and you agree, and you're like, yeah. Well, with a partnership, there's a little bit more flexibility, and you put in some additional capital. Well, we can allocate you some more deductions as a result of that. Even though we're 50-50 owners, and we're spending money because you put in that extra money, we can allocate you a little bit more deductions than I'm getting allocated. And eventually it's going to work out to where we get back to that 50-50. As the company makes more money, you might get allocated more income, but you have more flexibility with a partnership than you do with an S-Corp. With an
Okay.
S corporation, one of the other restrictions is everything must be allocated pro rata. So
Mm,
if you and I, same thing, you and I get into an S corporation, we both put in $10,000 initially, um, and we're like, oh, we need some more capital. It can't be, all right, Xavier's going to put in 10,000 and I'm going to sit idle. That's not allowed with an S
gotcha.
corporation. Whatever you put in, I've got to put in. And then anytime you take money out and get a distribution, I've got to get the same
Hmm.
distribution. So an S corporation, a little bit more constricted in um, how you can flow some of the activity and the flexibility that you have, and being able to capitalize the company and then take money out of the company.
Yeah. And this popped into my head as we're sitting here talking about this. When dealing with an LLC, you and I have this LLC. What happens if there's a premature death to one of the business owners? You have two. Is that LLC shut down? Can I continue to run that LLC? What happens in that case?
Uh, Generally, the LLC will continue to run, and the ownership. So going back to our example where you and I
Mhm.
own 50-50, you pass, it's going to, that your 50% ownership is going to go to your estate, which
Okay.
will eventually get passed to your heirs. It won't shut down. Uh, in years past, pre 2018, if we talked about the partnership, yeah, the tax status of being a partnership if you didn't
Hmm.
do S corp. In those situations, you did have something where when more than 50% owner had passed away or ownership had changed hands, it was called a technical termination, where the partnership automatically dissolved.
Okay.
But that, in certain situations, for the most
Okay.
part, that is no longer the case,
Okay.
where it can still kind of continue on. Now, look, there's other things to consider, whether the heirs want to keep it going, and whether they want to sell their side or keep the business going.
Hmm.
But a death of a partner doesn't necessarily dissolve the LLC
Okay.
um, for those
All right.
purposes.
So ultimately, if I understand correctly from today's conversation, that the choice between an LLC and an S corp is going to depend on a couple different factors. One being the business size, the
Hmm.
ownership structure that we choose, our tax considerations, and then what our goals are, what we're trying to
Exactly. Yeah.
accomplish. Okay. And again, I'm going to stress to everyone out there, for our business owners, definitely when you're going out there and trying to decide which route to go, how to file, definitely consult with the CPA, with your tax consultants. Let them help you out because it's tricky. I mean, I've been practicing now in the financial services industry for 22 years. And again, I know enough to be dangerous. So, Keith, I want to appreciate or thank you for coming. I truly appreciate you coming. I know now, you're in the thick of it with tax season in what, April 15th? So we're only a couple weeks left.
Yeah, we're a couple weeks out. It's we're ramping up for sure,
Mhm. Yeah, I
for
had
sure.
I've got a couple calls over the last week and a half, 2 weeks, asking who do you know that I can get to do my taxes. Like, well, I'm like, most of these guys are extremely busy right now. So, but I do want to say thank you for coming on. Anything you'd like to say in closing?
No, I would say, yeah, yeah. When you're considering opening a business, or if you already have the business and want to create the LLC, there's plenty of different factors, and there's also plenty of considerations you need to make when thinking about your expenses for the business. And lots of times it's things that aren't, everyone is familiar and knows about your direct expenses, your upfront expenses. You've got, you know, obviously the direct cost of the business. If we're using a pharmacy, for example, it's obviously the cost of the meds.
Hmm.
You might have rent, overhead, your employees, stuff like that. But then there's other things to consider. You might have some travel expenses. You might be doing continuing education. Um, You may, as a business owner, you may be using your home for certain business things, whether it's a home office, doing stuff at home. So there's a home office deduction you want to consider. There's your vehicles that, when you're using your vehicle for business purposes, may not be 100% for business, but you want to make sure you capture all that because um, those things can add up, and you want to just make sure you're capturing all of your business activity because if you miss some expenses, um, that's tax dollars that could be in your pocket that you're ultimately could be paying to the government um, that you just don't want to miss out on. So it's important to when you're coming up with your plan to make sure that you're consulting with someone that is familiar with those array of business deductions, so you don't miss out on anything.
You said a mouthful there, and I think I think we could actually get an entire podcast talking about expenses and deductions and
Yeah,
that type of
yeah. Because
stuff.
look, there's things that uh, there's certain things that are not deductible that you may realize. A lot of people know about the meals and entertainment
Hmm.
that you can deduct half of that, which the rules have actually changed within the last 5 years on those things. So it's important that you have someone that's up to speed on those rules, but also all the other things I talked about. It's
Hmm.
you know. It's funny in the years that I've been doing stuff and working with clients. I actually get some pretty crazy questions about, hey, can I deduct this or can I deduct that? Um, Sometimes, it's usually a discussion. Well, would you use
Hmm.
it for this or did you do it for that? Sometimes it's a no, that's that's
Right.
absolutely not a business deduction. So but if they don't ask, they won't know. So
Right.
that it's important to when you're the one of the things that I remember the partner telling me is when you have a business, you think about your income statement and all your revenues. One of the biggest items on that list can be taxes. It's usually one of the bigger numbers, so you should put some time and effort into it to make sure that you get it right.
So, do I have a commitment for you to come back on and let's talk about expenses?
Yeah, I think
All
so.
right.
Absolutely, I'd be happy to do that.
Well, sounds good. Well, I'm looking forward to getting you back on and talking more about taxes. So, Keith Raymond, CPA. Keith, I want to thank you for coming on, and it's a pleasure. And looking forward to talking to you again.
Thank you for having me, Xavier. Very much appreciate it and looking forward to it as well.